All right, so mutual funds. Let's see. I got the third section, which is basically balance sheets and recent trends. Well, the first, basically, law of investing, now I'm switching to investing, is very simple. Ordinary investors, and I explained this a while ago, ordinary investors are always wrong. Again, most of the times, investors have what's known as investor fad. A fad is like a fashion, having a pink bag, or special shoes, or special hairstyle, or special clothes, or shirts, or whatever. Fad is a substitute for a fashion. And one of the most important rules of success, or means successful investing, is to recognize a fad. When you recognize a fad, you stay away from it. Fad is associated with most people recognizing that something is profitable and investing in it. But again, remember the simple thing. In order to be successful, when you invest, the price must go up. There's only one way for the price to go up. There gotta be more investors to buy. When the majority of people buys, there's no one left to buy. And if there's no one left to buy, there's only one thing left for the price to go down. So, fads must be avoided, and fads can grow into bubbles. So, what is a bubble? A bubble is a fad fueled by credit. So, bubble is best defined and understood as leveraged speculation. Leveraged speculation. Leveraged means massive amount of borrowing. And speculation means buyers buying for the purpose of profit, of profiteering, of gaining quick and hopefully easy profits. And leverage speculation, that's the cause, the result, or the symptom is rising prices. Rising prices. So the price of houses goes up, and prices rise significantly above inflation. If inflation is 3%, housing goes up by 15%. Do you have this going on here in town? A lot of it. Housing going up 20%. Everyone is eager to buy. When everyone means it's a fad. And people, leverage means borrowed money. People do it with borrowed money, basically credit. So, In general, investors, this is again part of what is known as behavioral finance. Behavioral finance is a branch of finance and a subfield of economics that explains investment decisions with human psychology. Human psychology is that the natural thing for human is that you do what others do. If others are buying SUVs, you buy an SUV. If others have iPhones, you also want to have an iPhone. If others are buying technology stocks and making profits from technology stocks, you also want to buy a technology stock, okay? This is called and is known as herd behavior. Herd means a group of animals who behave in a similar way. Herd behavior is genetically programmed to humans in general, and all animals for survival. It's extremely important for survival. So, seeing and doing what others do, people believe, as well as animals, believe to be relatively safe. So, behavioral finance basically attempts to explain a lot of investing and some of it with herd behavior. And again, so you will look in here at investor psychology. And investors basically rush in groups. They think alike, they follow each other, okay? So, investors rush to buy, like everyone is buying a real estate, and everybody believes that real estate will be profitable. And they drive prices sky high, and here's the key: fueled by bank credit or fueled by borrowing. When the credit dries up, the market crashes. So, investors in generally follow fads, okay? And investors generally, here's the key, follow the market. Follow the market. Let's try this. 1919 and 1920 was a horrible year for the US economy, and the stock market crashed. The market bottomed in 1921 and began to rise all the way until it peaked in 1929. So for 8 consecutive years, the market went up and up and up and up and up and up. Now, people, ordinary common investors, did not invest in 1921. They didn't invest in 22. They didn't invest in 23. Not in 24, not in 25, not in 26. They began to invest in 1928 or so. Again, they waited for 7 years. Most of the market was already up, and only close to the very end, they invested heavily, of course borrowed a lot, and soon after that, the market crashed on them, okay? Now, in the US, 1994 before the Federal Reserve raised interest rates and real estate crashed in a whole bunch of areas. Well, in 1995, real estate stabilized, okay? So real estate went up for many years, but the real bubble began 2004, 2005. And most people got into real estate in about 2005. And the real estate market peaked in 2007. So prices were up for over 10 years, and only then investors began to invest heavily into real estate, meaning everybody was into real estate. Now, 1989 and 1990 was a very bad year for the stock market, and from that point on, the stock market really took off. This is the technology bubble. The technology bubble burst in, well, let's call it 2000, March 2000. In 2000. And again, stock market is up and up, 7, 8 years up. And somewhere around 1998, and especially 1999, people began to move heavily into the market. And the market began to go up, what's called parabolic. So, for 8 years, the market is rising steadily and people don't invest into it. And then, suddenly they all rush into it, close to the very end, okay? So, that's a typical pattern. Gold bottomed out. It had a double bottom, 1999. And then the second bottom was in 2001. Okay. At whatever, $230, $40. Gold went up and steadily up. It doubled for a while, then it tripled for a while. Then in 2008 crisis, as real estate crashed and the stock market crashed, okay? At that point, investors got scared out of real estate. They got scared out of gold. Just about 2010, maybe 2009, maybe more fair, let's write in 2009. Investors all rushed again into gold. Gold's been up for 8 years. They wouldn't invest in gold. Why would they? They'd rather invest in real estate. And in 2009, they invest so that by 2011, the gold would make a major peak and crash and burn all of those investors. Again, the same pattern over and over. Investors see something going up 7, 8, 9, 10, 12 years, okay? And then, once they are, here's the key word, convinced that it's a great investment, only then they invest into it. So, retail, or these small investors, are always late to the game. The game's been going on, meaning profits have been going on for too long, and only at the very end, they actually rush to invest. Price already doubled, the price already tripled, and they think that it's going to double and triple from there on, which of course is partly true, partly false, meaning yes, it may double from that point on, but it may crash and fall 3 times eventually. So, 1966 is a memorable year when the stock market peaked, and at the same time gold bottomed out. And from that point, 1966, the stock market was going nowhere. We call this secular bear market, and gold began moving up and steadily up. So people throughout the late 60s and early 70s, as gold was steadily rising, invested mostly in stocks, and somewhere the big shift happened in about 1978 up to 1980. So 1978, stock market wasn't going anywhere and partly down for 12 years. Only then people realized stock market isn't doing anything. It's kind of like the stock market is dead. And seeing at the same time that gold's been up for the last 10 years, only then people, we say, sold their stocks and bought gold. We say rotated out of stocks and into gold. And only then they made the final push to double the price of gold. And in 1980 and on, gold crashed again. And again, the same thing. They see a trend going on for 10 years, sometimes 8, sometimes 10, sometimes 12. And right at the very end, or close to the very end, investors usually rush to do the thing. Well, now, today, the biggest fad in investing is, and that's got to scare a lot of people, the biggest fad in investing is ETFs. And close to half of retail investing is into ETFs. The worst part is that you got a lot of professional investors like mutual funds and hedge funds who also invest into ETFs without understanding the workings and the mechanisms of ETFs. ETFs are a relatively new, recent financial innovation. They're untested. But the one thing which we, at least in the classroom, understand, but investors don't, is that it's a derivative. And derivatives are known to be weapons of mass destruction. When derivatives grow to a significant size, significantly larger than the financial markets, the underlying market, at that point, derivatives usually blow up, and a collapse of the financial market usually results as a derivative. Most catastrophic financial market crashes have been triggered by and driven by derivatives. Doesn't mean they were caused by derivatives. And derivatives have usually inherent leverage in them, which makes things infinitely worse. All right, so let's see what else we got. All right, next thing is regulation. Financial markets are the place to make money. To make money hopefully quick and hopefully easy. All financial markets everywhere in the world have one very important constant. Something which is always present. That's the one thing that you should never forget. It's called fraud. Since the beginning of financial markets, fraud has always been present, and governments have always tried to get rid of fraud, and they have never been successful. Fraud has the nature of alcohol. A lot of cultures, a lot of governments in society have tried to get rid of alcohol, but if people like alcohol, they do alcohol, and no amount of laws will ever prohibit alcohol from a culture or, from people. Same thing is with fraud. So there is, early on in the 1920s, there was a major stock market bubble. The stock market burst in 1929. From 1930 till 1937 was the Great Depression. During the stock market going down, was revealed that there was phenomenal amount of fraud during the bubble years. So Congress had in 19 1933 and 1934, known as the Securities Act. Securities Act. It was supposed to regulate financial markets. It was supposed to put a regulator to oversee that markets are properly regulated so that investors don't get screwed, so that companies provide information, so that there is a regulator to do the job, okay? And then, let me see some years. Again, that didn't seem to eliminate or reduce too much fraud. That seemed to be, fraudsters look at the law, they always go around the law. So in 1940, a lot more laws had to be enacted. Investment advisors. Investment Advisors Act was a law about what investment advisors, they should be registered, they should know what they're doing, they should be licensed, they should be educated and all the nice things. And another one was Investment Company Act, basically regulating mutual funds and all of those things. Again, the three major complaints will be, number one, within the fraud in general. Conflict of interest. The advisor selling the stock or the bond, the security from which they will benefit somehow personally. It maybe they have their own investment there, or maybe they'll get a bigger, better, juicier commission. So conflict of interest was the big one. The second one, almost always there, but by design hidden, is excessive fees. You always, as an investment company or broker, want to charge the customers, but the trick is to charge them in a way so they don't understand they get charged excessively. You charge them always too much, and you always do it by tricking them into believing that they're paying low fees when in reality they're paying relatively high or very high. So excessive, what is it, fees? Yes, fees. Excessive fees come in two ways. First is non-disclosure. In a sense, they have a fee, but they don't really tell you about the fee, or they don't tell you about all the fees. And the second, which is very almost the same, is hidden fees. They tell you about this and this fee, but they don't tell you about that extra fee. Okay? So that's a very common part of the fraud. Okay? And well, yeah, number two, it's just basics, old fraud. I don't want to get into law, but you guys all understand what fraud means. It's like cheating investors and stuff. All right, so 1988, more laws. We don't need, it's called insider trading. Insider trading going on. Again, 1990, barely 2 years later. Again, here, 93, there's one law. 94, there's another law, because the first one, people realized very quickly wasn't enough. Okay, more laws. 1988, one law. 2 years later, another law, again, because people, again, realize that there is more fraud than they originally think. And again, there's 1996, even more fraud, National Securities Market Improvement Act. Market Improvement Act means market's working, but not really. There is some fraud going on. We need to make a little bit of tweaks here, a little bit of tweaks there. And then, when in 2000 the stock market bubble burst, somewhere in about 2002 or 2003, I can't remember, there was yet another one. Lots of fraud, lots of cheating, lots of lying. Lots of people lost fortunes, or most of their fortunes. There was another one, Sarbanes-Oxley. And Sarbanes-Oxley was yet another one to prevent fraud. So fraud shifted in a completely different direction. Fraud shifted in 2003 to 2007, was in the real estate bubble. So 2003 until 2007 was in the real estate bubble. During the real estate bubble, there was a lot of, this time, credit fraud. One type of credit fraud was they give real estate mortgages to people who, let's say, couldn't read English. They didn't understand what the contract was. They didn't understand the terms and conditions. They just signed to something they had no idea. Basically, they signed into a trap. Another part of the fraud is they lent money to people who were long ago dead. In other words, you find somebody who's dead and you borrow on their name. Another common fraud was parents having bought a house or whatever and couldn't borrow anymore for whatever reasons, will take their little baby, 1-year-old baby that still sucks milk from her mother, they would buy house, and it's going to be on the baby's name, and the baby will be the borrower. So a 1-year-old or 6 months old will borrow for 30 years, and you don't expect this baby to have any income whatsoever. Okay? So in general, there was tons and tons of fraud, and later on, again, more laws to try to prevent. Again, what you don't need to know is all the specific laws, but what you need to know that there are dozens and dozens of laws. Every couple of years there's a new law trying to fight fraud and cheating and lying, and as soon as there is a law, next time they make another way of doing it. So it is in the nature of financial markets. That's part of financial markets. And it happens just as much, maybe a lot more in China. Fraud happens just as much in Japan. It happens a lot more in countries like Russia and in countries like Thailand, where laws are weak. But even when laws are extremely strong, like the US and UK, there is tons and tons of fraud. So, the investors were, and I'm going here to the kind of like next mini session, investors in mutual funds eventually were caught cheating in many different ways. Now we're getting to, well, I don't have the page for you. Let's see how they cheating. It's called trading abuses, same as fraud. And I have here in the textbook just about 4 of them. So, the first big trading, now these are frauds specific to mutual funds, is called market timing. Market timing. Market timing is you try somehow to time the market. So what you do is you do short-term trading, and you use short-term trading. Now, it's very important to understand, for example, that a mutual fund will not trade during the day. It will have only one price at the end of closing, 4:15, 4:30, up to 5 o'clock. Market closes at 4, so 15, 20, 30, 40 minutes, you're going to have a price on it. And if you have to sell, you sell at that price. If you want to buy, you can buy at that price. Well, here's what happens. Because you can buy at that price up until the morning, there may be new information like a new interest rate change, or something happened in Japan, or something happened in China that will obviously affect your price. So maybe 5, 6, 7 o'clock in the morning, tons and tons of new information already. Remember, 6 o'clock in the morning, the Japanese market has already traded and closed, the Australian market has already traded and closed, all Asian markets already traded and closed. By 7 o'clock in the morning in the US, European markets have traded. You've already seen what happened with car makers and pharmaceuticals and all the other stuff. And you expect that the similar trend that started out in Asia, carried through Europe, will also carry into the US. So, when you time the market, you see information that has come after the closing, and you buy, for example, if you own the fund, you buy early on, and when the market closes, it closes up significantly, and there's a better chance for you to profit out of that information. So at the end of the day, as long as the market holds, you're able to make a relatively secure gain. Okay? So that's simple market timing. The key is that they hold its own. This is very important to be short term. Just 1, 2, maybe up to 3 days, okay? So that's market timing. Number 2 is called late trading. Late trading means the following. Market closes at 4 o'clock, the price is at 4:15, and let's say, I'm picking for illustration, but it's pretty much the way it works, is you can put your order to buy or sell your fund up until 12 o'clock lunchtime. So, if you put your order, I want to buy the mutual fund, you can't say, I want to buy at 5 o'clock in the afternoon or 7 o'clock in the afternoon. You gotta say in the morning that you want to buy the mutual fund, and when the fund closes, they will get the shares for you. That's in general how it works. So you can't just buy at 11 or 12 o'clock. You put in all your order, and your order will be executed at the end of the day when the fund closes. So when the fund closes, they'll fix the price. Everybody who wants to sell will sell only at that price, and everybody who wants to buy will buy only at that price. Okay? Well, you can put in your buy or sell order by 12 o'clock because it needs 3, 4, 5 hours to process the paperwork and everything else, so they can actually execute in the evening. Well, late trading means that you don't put in your order at 12 o'clock, but you and me are friends, okay? And you manage the paperwork. And I should give the paperwork by 12 o'clock and you'll execute my trade. But instead, because we are friends, I'll see what happens to the mutual fund. And if the mutual fund moves, let's say, up, I will give you the papers much later in the day, maybe 4 o'clock, and you'll process them for me quickly and, you know, execute my trade. So late trading is the order must come until 12 o'clock without knowing what the market did. But you actually put your trade at 3:50 or 4 or 4:15 and you execute the trade after you know what the market did and after the market closed. So you already know what happened to the market, okay? And at that point you trade. Well, that's a very easy mechanism to trade. If you can trade with yesterday's price, I mean, you could be billionaires in no time. Well, that's what these people did. They became millionaires by trading, we call it late trading the fund, by already seeing and knowing what the price is and then trading on that information. Again, that's pure fraud. Law clearly says that it can't have it, but they did it anyway. They made millions out of it. Number 3 was more ordinary, but still strictly illegal and still fraud. It's called directed brokerage. So this is basically a simple agreement. It's agreement of the brokerage house, the broker. So it's an agreement between the broker to direct investors into mutual funds of that particular mutual fund sponsor. Okay? And the sponsor will pay the broker extra fees on the back end. So, for example, I'm a broker. I'm covering 10 different mutual funds, and I can offer fund number 1, fund number 2, fund number 3, fund number 4, and fund number 5. And I get the same commission. But you come along, because we are friends, right? And you say, I'll give you an extra 0.5%. Well, 0.5% is like a ton of money. Like, if I can make today 1 million of investments, 1 million of investments, okay? Well, 1% is like $10,000, which is good money. So, if you give me an extra 0.5% pocket and money in my pocket, that's like $5,000. Now, $5,000, this is technically a bribe. You're bribing me, instead of giving it to fund number 1 or fund number 2, to give it to your fund. Now, I'm going to get my salary as a broker. Broker salaries are very, very small. I'm going to get a huge regular commission for my regular business, and that little 0.5% will be equal to $5,000, which is extremely good money for 1 day of work, 1 day of fraud. Okay, and we can do tomorrow again. I get another 5. Well, before the week is over, I can make 25,000 of nice little fraud in a week. Well, you multiply by 4, and in a month I can make 100,000. These are just the bribes. Extra is my salary, extra is everything else which I get. Well, that's basically directed brokerage. And if you can find a way to pay me so that we don't record the payment. I don't even have to pay taxes on those $100,000. They rate the brokerage extra fees. It's a nice little juicy fraud where to make 100,000. Well, now multiply for a year, and I can make out of my arrangement with you easily as a broker $1 million. That's why a lot of people want to be brokers and like to be brokers. Because if you get into a fraudulent scheme like this one, and there are many different fraudulent schemes, you could easily make $1 million, at least in New York, in the US, on Wall Street, but also in Tokyo and now in Shanghai. It's relatively easy. You can easily make $1 million based on fraud. And it's better than that. In countries like China and other developed countries, back in the previous 1995, 6, 97 bubble in Thailand, these laws didn't exist. So we can make our arrangements. I can make me $1 million, and the best part, it's perfectly legal. There's nothing wrong with that. Well, there's nothing wrong with that, except that the investors get cheated out of their money. Now, the best book that I have read, so that you guys, when I get your 10-minute break, which I recommend, or anybody should basically read at one point, it's not so easy to find, is called the Mutual Fund Trap. Probably I don't have it with me, I should have been teaching basically from this book. It's about the hundreds of different ways in which common, ordinary investors get cheated out of their money. Mutual funds are presented as the way for investments to go, and the book shows not only hundreds of ways in which investors are getting tricked and cheated, but basically reveals that most investors lose money most of the time in mutual funds. Mutual funds in general are a losing proposition. Now, for a while, the market's already made up some money. You put in your money, and for a short while, you continue to make money and feel good, but eventually, most investors lose. Remember, if the market is, let's say, at 10,000, and after 5 years it's at 10,000, all the brokerage fees and everything which Wall Street made must be made from a loss by ordinary investors. And that's how the financial markets are designed. They're designed to suck money out of ordinary, unsophisticated investors into the hands of Wall Street operators. These will be mutual funds, hedge funds, pension funds, traders, whatever. The whole Wall Street financial community. And the last to understand, extremely, oh geez, I thought I had something else, but that's okay. The next to understand is one of the biggest frauds in financial, now it's called intellectual ideas, called, to understand, this is very important, stocks. And you can do, it's very quick, you gotta type it exactly the same. Stocks for the long run. It's a book written by Jeremy Siegel, who made it very popular with investors by claiming that if you invest for the long run, investors always made money, which is basically certainly not true. But he had to select his data in a certain way, and later on, at least for some of you, you can use different statistics in different ways to calculate things so that you can get the results that you want. So he used manipulative statistics, not quite correct, okay? But he was able to scientifically show with data that if you invest in stocks, you're always doing okay as long as you hold for the long run. And that book suddenly became the most popular book on the market. Wall Street loved it because it justified the existence of Wall Street. It justified its profits. And suddenly, people began to believe absolutely incorrectly that if you invest in the stock market, you always win. Now, people that invested in 1929 in the stock market, of course, eventually won. They came up with their money back in 1945. So, you had to wait for 16 years just to get your money back, and there was a return, and there was an inflation in the meantime. So, after 16 years, you made zero return. After that, you made eventually. If you invested in 27, 28, 29 to get a decent return, you'll have to wait until 1966 when the stock market peaked again. So, if you invested for 35 years, you would make a little bit of money. But again, you should be able to hold through all the hard times for about 30 years. If the long run is 30 or 40 years, you can make some money on the stock market, not very good. Again, if you invested in 1966, all the way till 1980, you didn't make a lot of money, you lost a lot of money, and you kept losing all the way along. And in order to make your money back, he showed, which is true, that you'd have to be invested all the way to 1999. Wow, from 66 to 99, you got to invest for 33 years and be able to hold just to make a little bit of money. Which of course is totally wrong. If you just have to hold for 5, 10, 15, or 20 years, you're sure going to lose money. Okay? So investing in the long run is usually a bad strategy when the stock market is overvalued like it was in 25, 26, 27, 29. If it's overvalued like 63, 4, 5, 6. If it's overvalued like 97, 98, 99, or 2000. Or if it's overvalued again in 2008. So it's a basic common sense law of investing. As long as you're investing in heavily overvalued assets, you're bound to lose money. The only way to successful investing is to invest in undervalued assets, only if assets are cheap. For example, right now, and the bubble hasn't quite burst yet, in Chiang Mai, you can buy small little condos, kind of like apartments, for about $9,000, $10,000 or $12,000. It's perfectly possible. When we had a real estate bubble in Bulgaria and have this nice, beautiful ski resort, small little apartment, let's say 35, 40 square meters, we'll say 40 square meters will sell for $40,000, $50,000, even $60,000, okay. Well, as the bubble burst in 2008, $50,000 in just a couple of years became $40,000, and in 2 more years became $30,000, and a few more years became $20,000, and now they are sold nice, good luxury properties, well built, for about $10,000. They're cheap, and they're still not selling quite well. So that's an example of how much real estate could crash. And again, the arrow is still down. Now, in Brazil, very, very poor country, real estate during a major bubble went all the way up to $100,000. And as the bubble burst and burst and burst, and the real estate prices went down, 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 and further down, at the bottom, they were barely 10,000. And that's in the capital, nice, good luxury properties. So real estate can easily fall 5 or 10 times, okay? You buy overvalued, you're most likely, most surely to lose money. If you buy it dirt cheap, there is a better chance to make a profit. All right, it's good enough.